Welcome back to another episode of Fun Friday with another friend, of course, on the show, the founder of Sondhi Capital, Nishant Sondhi. How are you today?
I'm doing well, Craig. How are you?
I'm doing great, thank you. I'm excited for a conversation. We've had the pleasure of meeting in several places, corresponding, kind of getting to know each other really well over the last part of this year, and looking forward to hopefully earning your business and trust and raising some capital from you and your people. But before we get into that, would love for everyone to kind of hear your story, your background, and how you got into the chair you're in today.
Great. Well, firstly, thank you, Craig, for having me, and hello to all your listeners out there. Well, I was born in the US and I lived here for maybe when I was 4 or 5, and my parents migrated to India at that point. And in 2018, so slightly north of 6 years, that's when I decided at the age of 29 that I have a US passport lying, and at least I should go once to the US and see, just give it a shot and take it from there. I really liked it from the get go. I started off with a job in healthcare business, but real estate really excited me because I started attending real estate conferences, and I felt that there is a big opportunity here. And in 2019, I started off as a real estate broker in Manhattan, largely because I felt that's a great way to enter the real estate space. Very low startup costs, an opportunity in Manhattan to build a good network for myself, and that network not just limited to New York City, that would go to New Jersey and Connecticut. And I always had this back of mind as a plan that okay, maybe if I give this a couple of years and build a good network, now I have an asset with me, if I may say so, and I can then from there look into different opportunities, which could be single family investing, multifamily, fix and flip. At that point, everything seemed exciting. So start off as broker in 2019 wasn't as smooth sailing as I would have thought so. Well, 12 months moving into probably the most competitive market in the world. I grossly underestimated that. But that taught me a lot. Then 2020 was COVID time. I was really hustled in 2019, hoping to get some good sales in 2020, but I lost most of the spring market. Though kept my head down, hustled, and got some good sales by the end of 2020 to give enough momentum to build a good practice by 21, 22. And what happened after 3.5, 4 years, and I'm still licensed to New York City as a real estate broker, but not agent, sorry, but I'm not actively practicing. I saw that I was looking for an opportunity which would give me more scale. So most times in my personal life or profession, I would go out and meet people, and people would ask me for good real estate investing opportunities. And I realized that that problem is a lot bigger than I thought so. For example, hey, I have this extra 100,000, $200,000. I want to invest in real estate. Do you know of any good deals? Oh, I don't want to trek in the weekend to go 2 hours far. And mind you, my network was mostly tri-state area, so predominantly expensive market, especially New York and New Jersey. And then people are not going to go. They had that stress that they don't want to track 2 hours down on the weekend, and the high carrying costs when you're going to make deals, paying broker fee, worried about getting tenants, toilets, termites, and then the numbers weren't working up as well in single family investing. So people have pushed that away and start focusing on just index funds or stocks or the traditional liquid assets. But people want to do something real estate. They wanted tax advantages. People wanted that cash flow. So I felt, how could I get involved? Because we knew at that point there's a lot of action happening in the Sun Belt region, especially. We would hear a lot about Texas, Florida, and South Carolina, but sitting in New York and New Jersey, we had no idea of how to get involved. So late 22, early 23, when the interest rates started to go up, and truth be told, my real estate agent practice in Manhattan was started to suffer, and I could foresee with the changes in the broker commission laws coming. I also wanted more flexibility from rather than living in New York. Maybe I want to change states or even spend some more time international. And I didn't, being an agent, I wasn't getting that kind of location flexibility, to be honest. And that's when 23, I saw this as an opportunity that, okay, why don't I start directly approaching top operators in the Sunbelt region, with the only play being that, hey, I know if there are any good deals, firstly, can I invest? And then I have a very good network and I can possibly get them involved. Again, I had no idea how I'm going to go about it. I did this for the large part in 2023, did 4 deals, some build to rent projects, new developments, worked for a bit with a 1099 company. I did the whole of this in 23 to really learn the business. And because I didn't want to go down the typical path of co-GP and just to let your listeners know, but to be a co-general partner, you have to take responsibility on the property, which goes slightly beyond raising capital. Well, I was just raising capital. So I wanted to be sure that I'm compliant throughout, so that even if that required me to work as a consultant with a PE firm or take on different roles as a GP to learn the business. And after getting some momentum and good raises, late 23, I started my own fund. It's a customizable fund giving investors access to different type of asset classes within the multifamily world, which I work in, maybe value add, build to rent, and even new developments, because for different investor avatars, they have different needs. So I've done 6 days of year working on my seventh, working with top operators like Lone Star Capital, and a lot of it is building a portfolio from investors, myself, seeing good opportunities, vetting them, and presenting the best to my investors. So I know I spoke for a bit, but I wanted to give a very high level overview of my experience in this business and coming to the US.
My job's a lot easier when my guests are great talkers like yourself. So thank you so much for doing it, and always feel free to go on an extent and don't spare a detail. But that's awesome. I think geographically speaking, I can really relate to what you're talking about there. I once was a residential broker in the Silicon Valley in the Bay Area, and similar to New York, probably two of the most expensive markets in the world are truly the Bay Area and New York City, right? I think no one's going to argue that. Very expensive to get into it. And a lot of the times, if you buy something, leasing is a lot more common in New York. You can make really good money as a leasing broker. But if you're going to buy something in New York or buy something in the Bay Area, maybe you have extra cash laying around, but you really can't invest in your backyard. Like, that's not really a feasible option. Also, a lot of people are looking around, especially sophisticated people in the Silicon Valley and New York, and looking around like, okay, well, there's other great growth markets in other states. Maybe their companies got, headquarters in Dallas or Houston or Florida or something like that, Arizona, whatever it may be, those sunshine states, as you alluded to, where they want exposure there, but they don't have time to go out, find a realtor. They don't have time to even own a property and put third-party managing on it. They kind of just want a turnkey solution. So it's funny, although you're in New York, which has a lot of disadvantages, your advantages to being in New York City is if you do a deal to one person or two people that may have extra capital laying around, you do a good job with that relationship, you are going to be their source to have really high net worth individuals who might invest with you, and then also ideally give you referrals in the future to make your raising processes easier. Is that kind of what you experienced?
Yes, and I think that's a great point because, um, like San Francisco, New York City, most of these folks are really busy. And being a broker myself, I realized one thing, and then this is what I would, probably warn investors before they would get it. It's a lot of work. Like by the time you're going to go through tons of properties, you're going to go and see them, then you're going to start writing offers. Most likely, there's going to be a lot of back and forth. Then you're trying to make the numbers work, and to really hit that deal is not that easy. Then after that, the whole process of potentially getting a mortgage, working with the tenant, it's a lot of work. And I would like to just always tell my investors that, look, you need to be aware before you're getting in that it's going to be some time investment, it's going to be some work. And being a broker myself, I've had so many of those experiences that I could confidently guide my investors that, hey, there could be better use of a capital with institution level players out there with strong teams, great in-house due diligence, fantastic reporting, proven track records, and true incentive alignment in terms of how deals are structured for you to win and eventually get the best returns. And my question always to an investor sitting out there, and most of, as I say, about 80% of my investor network comes from the tri-state region, would be: are you looking to be an investor or an operator? Because if you're looking to be an investor, you're end of the day out there hunting for the best deals, you're looking for the best returns and the best due diligence possible for you to make the right decision. There'll always be some inherent risk in any investment. If you're looking to be an operator, it's a different conversation. And I think that would really strike with my network because they realize that that's what they're doing already in the stock market. That's what they're already doing with index funds. They think like investors. They're like, okay, I want a balanced portfolio between S&P 500, then I want some tech stocks, etc. And why not think the same about real estate?
Yeah, no, I love that. And I think the other thing, people, the busier they get, you're a new father now. You understand this. The older you get, the less time that you have. And if you want to buy maybe a single family house, a duplex, a fourplex, some markets have different opportunities, so on and so forth. Then you're becoming an operator if you don't put third party management, if you're making those decisions there. Very few people really do have enough time with how busy we all are, with most, wives and husbands, if they're a family, now working or co-parenting, whatever it looks like, both of them working full-time jobs. So this time perspective, the amount of energy required to make that make sense for the most part is just too much of a burden up front. And the other thing to think about too is, I think a lot of people that you're talking about here, busy professionals, really value other professionals. They really value myself and you being in the weeds day in, day out, getting the information, getting the answers to make sure everyone feels comfortable with that. That's kind of the value that we provide naturally is, hey, you are going to have a pro take care of this, just like you have a, stockbroker, a professional there in that sense, manage your accounts, invest it for you, kind of give you a plan and whatnot with what you're looking for your goals. Well, similarly, that's what you do. That's what I do when we vet our kind of clients or people there. We kind of have an understanding of what they're looking for, maybe their risk tolerance, the return profile that they're seeking. And then we can see if it's a good fit or not. Maybe not everyone's a good fit, but all that's to say, we kind of facilitate that there. So I think when you are in the tri-state area, people actually really respect the value they're providing them because, it's very difficult to afford to live there, just like it was difficult for anyone to really afford to live in the Bay Area. And they do typically have discretionary income, but maybe they don't want to sign on loans. They don't want to deal with, the process of going through brokers and such and underwriting a bunch of deals to find one good one. We know it's so great that we actually truly give you a streamlined process where we give you the deal on a platter. It's available for you to raise or not. So I think that's a really cool thing that we get to provide to people.
Absolutely. And I believe it's a very good point you raised that people appreciate other professionals out there. They realize that in the world of investing, it's a full time job. You really can't wing it. For example, a lot of the new investors I speak with, and again, this is based on my own experience of being in the real estate space for over 5 years now in the US. If you're buying a primary home, that's different because again, you're looking more from a safety net perspective and emotional perspective. That's different. A lot goes into consideration before you go for your neighborhood. It could be kids, it could be your friends and family around. So that's a different
Grandparents are
conversation.
nearby. Yeah, it's not.
Absolutely.
It's really not in very many respects, a logical choice when you do choose to buy a home. Some people are making the argument right now too that is it even logical to own a home with all the costs associated? I, for one, think it is a valuable thing to do, but some people, mathematically speaking, if you look at the arbitrage play, seem to suggest otherwise. So, it's for sure, a either or thing. A lot of people say, well, no, you're actually better off putting your money in the S&P 500 and skimming the spread there and reinvesting in that there, and you'll look up and have that. I personally don't necessarily agree with that all the time, but there's cases on both sides of it.
Absolutely. So, one way is you look at your primary home. Then my view is that okay, unless you're buying a holiday home, for example, maybe you're looking at retiring in Miami, for example, or you want to use this as your, go there during the winter time, just throwing in an example. That's different because again, you're using the asset. But if you're looking purely as an investor, and how does it matter to you if you're investing, the deal is good in North Carolina or Minnesota? End of the day, the location, local dynamics needs to make sense. The business plan needs to make sense, and the people who are executing. And I think that's what my investors now, after having spent some time and speaking with different type of investor avatars out there, they feel that that value they seek from me is that okay, how are you vetting these deals, or how are you vetting these operators, and how are you out of, let's say, 50 deals getting four in front of me? Okay, what's making you select those four versus 50? And investors value that. They want to understand that okay, from a fund manager perspective, what's clicking with you, what's the rationale behind, and end of the day, what are the people who are supporting you to get the right deals, and how do you get the right deals?
Yeah, well, and I think you've done such an amazing and proactive, kind of way to really handle the business because you came from being pretty fresh in the space to being very successful in every single raise that you've done. You've raised a very meaningful amount of dollars, and I would argue the hardest time to do it in north of a decade, right, since the GFC. So the fact that you're able to kind of cut your teeth and to make that work, and raising a dollar now is like raising $3 when the market's hot. So you're going to get those benefits, and also from a cyclical perspective, you're going to invest in today's market where the cycle is restarting, and really only way is up from here, assuming you do the proper due diligence, which you do. And one thing I'll really tip the cap to you on is how productive you've been and how proactive you've been to go to all the conferences, to meet the right people, to network in the right rooms, to actually make relationships, not just via Zoom. We've met in person multiple times now. So we know who each other are. There's not a mystery what's going on here. It's before you've even worked with us, you've met with us, almost 10 times. That is the value that you're providing. It's not just a one-off, transactionary relationship in a sense. We're looking to build a meaningful relationship where we're working on a deal and a deal out where, we're a lot more transparent. Not that we'd ever not be transparent, but you're transparent to us. There's a mutual level of respect that we have because you're being so proactive. We're in the right rooms, we're in the right networks, and you also vet people out too because all the, networking and masterminds that you're in. You hear all the good and the bad, for the better or worse before you even get into a deal. So you kind of have your pulse on everything, which is, really the value that providing. So to all of your investors, if they're listening to this, Nishant, you've done such an amazing job with cultivating a name for yourself in the industry, but also doing the right steps to, prove as to why they should be investing with you.
Thank you, Craig. And it's really, I also appreciate partners like you. When, for example, I remember when we start off a conversation, and like you rightly said, relationship building takes time because end of the day it's a partnership. I feel that while at one level fund managers have the responsibility and of the investors and to be good stewards of the capital, to the right due diligence, to look for the right deals. At the same time, and we have certain expectations from operators to be transparent, but at the same time, I feel operators also should have certain expectations from fund managers in terms of transparency, of commitments, communication, updates, because end of the day, we all are time bound. So in my view, in the last year, what I have seen is that it's actually both of us we have working together to make the investors win, and that's where
Yeah.
incentive alignment is so aligned that to realize that actually we're one team, and how do we make it best work that everybody wins. And that's something which I love about this business is that how the deals are structured or waterfall structures are concerned, from the general partner to limited partner, even fund manager, all of them are aligned towards the success of the deal. And there are very few businesses out there, investments out there, which actually have that level of alignment. So I wanted to point that out is that it's only when everything comes together do we see that kind of success.
Right. No, and it's also really important to note too on, everything that we do, that you do, that I do, Lone Star does, Sondhi Capital Group does, is for the investor. The investor is a straw that stirs the drink. They are the king of the beach, so to speak. We kind of revolve around them, and then they leverage us for our expertise there, of course. But it's all about making sure that they have a good experience. And a thing that we really want to solidify to people, this is something that you've probably explained to a lot of your, investors as well, is we're also an asset class that is a liquid asset, meaning you cannot sell your stock. Let's say if you invest today, 6 months later you have an emergency event, you're looking to sell your positions. You can't do this in this product type. That's not common. If that happens, it's a really bad thing. We've only had to have that happen a couple of times. We've honored it. But we tell everyone coming in, what are your expectations? I really ask the questions. What are your intentions here? Can you stomach this? How would these $50,000? What would they mean to you if you invested it? Are these your last $50,000? We have to ask these tough questions where we got to get to the bottom if it's a mutual fit, because we don't want to take just money from anyone. We want to make sure that it is a smart sense of how you're deploying these dollars. Otherwise, I would tell you to look elsewhere or maybe invest back into yourself, depending on where you're at in your life cycle. Or hey, maybe what, you're not comfortable with the fact that we take a profit split after a certain return threshold. That's totally fine. But then, you're probably not looking in the syndication route to make an investment. So those are some of the questions that, I always ask when I have conversations, not even before, when we talk about us, I kind of make it all about the other person to make sure there's alignment, because quite frankly, sometimes there's not. So with that said, have you had to kind of explain to a lot of your, maybe potentially your people who were first, home clients, leasing clients in New York City, the tri-state area, that, hey, this is illiquid and you're kind of married to this deal until it basically goes full cycle?
Well, absolutely. I think and that question often comes up as well. Like, hey, can I get my money out, or how is it like? Will I know on a yearly basis how much it's gone up, and can I withdraw after a certain level? Real estate largely is illiquid, especially these product types. When typically, based on the track record of the partners I've worked with, we've seen somewhere between 3 to 5 year holds. It could be outliers as 2 years as well, or it could be 5 plus, but generally between the 3 to 5 years in terms of expectation setting, market cycle. There's a lot of things which are outside our control. So setting those expectations is helpful. And in fact, I turn it around to my investors that it's actually something which I like versus the stock market, because it shows the investor's commitment for the next 3 to 5 years. That means you're also giving the lead general partner sponsor enough time to execute on the business plan, not be worried about market cycles, and actually increase the probability of you getting a return. I think most people actually lose money in the stock market because they do not know how to react to market downturns, and they may end up selling it potentially at a loss or below its true value, which they could have got maybe a few months ago later. But in real estate, if you stick with the deal for 3 to 5 years, and we know that experts are handling at the helm of things, we know for sure there's a higher probability that they will know how to work through the downturns. There are going to be some difficult times, and potentially get us our returns at the end of the day. And that's why it's so important to work with the right partner. And when I put it across like this to them, they understand, because, like you said, most investors I'm working with are accredited investors. I'm a Pfizer 60 fund, so they they would be qualifying to make over $200,000 a year, or as a couple $300,000 a year, or their net income being at least $1 million, except for their primary home. So a lot of them do understand that, okay, to really succeed in investments, you really you need to give time. You can be lucky and things can move in 2 years, but hey, 3 to 5 years is where it is. And I've seen that if there's a cash flow component to the deal, especially from the get go, that tends to give investors a lot more confidence because they feel they can hang on to the deal later. Yes, so to answer your question, I feel it's really important that investors do understand that it's a hold in period, but that hold in period is actually good for you. It just increases the probability of you getting your returns, in my view.
Yeah, it's actually a really interesting perspective you mentioned there, which is if you are maybe an erratic person, you're an emotional person, you're the individual that maybe got a stock ticker in your stocks as your home screen. These investment profiles might actually be a godsend for you because you can't impulse buy or sell. They're locked in there. So for the better or worse, you are locked into that opportunity, and your emotions can't get the best of you. And if let's say a bad economic thing happens, a black swan event happens, well, hey, guess what? You'll likely with the debt term there ride out that, opportunity and stay in it or extend it and not lose your money versus, yeah, if you buy it today and your stock goes down, you're selling that at a bad position, which is you don't want to do that, right? So I think the lockup period actually has a lot of pros and cons. And actually someone who was just on the show, Daniel Humlund, actually mentioned that he said real estate is underrated because it's slow moving. And not only is it underrated because it's slow moving, it's underrated because you can't just sell it at a whim. There's a business plan, there's a cycle process to these deals that you get to do in the real estate business, which is unique.
Absolutely, and I think just to add from a stock market perspective, and I think stock market investing is great. I just feel it requires a lot of homework, a certain level of expertise, as much as probably real estate does. But there's also a lot of information overload out there, which probably newer, or I would say newer investors could be slightly more gullible to. Today, you have tons of websites out there, tons of stock advisors giving you almost free advice online, and it's hard to predict the future. So you can end up following a path. It can get difficult to form your own view. It can take time. It could probably mean you losing money as well. So while I'm all for a balanced portfolio and one must discuss with a licensed financial advisor, I do feel the whole period actually net works a lot better for an investor.
Yeah, no, I'd agree with that a lot. Let's segue into what you've worked on recently. So I guess maybe just generally speaking, what type of deals have you raised for and are you planning to raise for moving forward?
Sure. So my first selection in terms of deals always is I'm looking for where the market is at right now, assuming that the location ticks all my boxes. And in terms of location, if I'm looking for a more multifamily, new development or value add perspective, I'm always looking for something which is more landlord friendly, business friendly, where there's a lot of evidence of migration, people moving there, job growth. So there are certain tick boxes which I'm going to look at. I don't overcomplicate it. I just like to see some basic reports to get a sense. And there are a few handful of markets which really do excite me. So I'm going to first look what are the kind of trends happening. So far I've divided my portfolio between build to rent assets, new developments, and value add multifamily. I think from build to rent asset class, it works well for a certain type of investor, almost similar to new development. I would probably bucket them as the same type of investor because build to rent asset class or single family townhome style rental communities which are coming up. I feel these asset classes have a lot of potential simply because these townhome style homes give you the best of single family living where you have community living, you have your dog parks, you feel you have your you're solving for the American dream with a garage or with a garage and a small lawn behind for you. And we've seen that people end up staying longer there. Also, with home affordability getting more out of reach, this could be a very interesting segue. So, I feel built to rent asset classes to stay. I've worked on two projects. I've also done two new development deals in Brooklyn, New York City, which are more for two condo developments coming up in Prospect Park and Prospect Lefford Gardens. In essence, I know these markets well. I've sold a lot of real estate in Brooklyn, so I have a good sense of the kind of not only demographic that's looking over there, but more importantly, the kind of product that would be in demand in direct competition to Manhattan. So here, I would say I have a slight bias just based off my prior experience. My experience in the market also, like I mentioned, most of my network is from the tri-state region, so that also makes almost logical sense to have some product out there in the New York City region because there's some investors, quite honestly, and probably rightly so, if it's in your backyard, would like to go over the weekend or just have a look at it or just go for a tour to get a bit more comfortable. And I've been able to do that with two Brooklyn projects. And coming to value add multifamily is something which I've come in more from Q2, I would say, or end of Q1. I've really opened up and see how exciting this space is. I was slightly more focused before on build to rent and new development. But I've come to really like that asset class. And I see tons of opportunity because there is that investor who is looking from this is just my thought process. A lot of the feedback I've got also because now I have over 50 investors who invested with me in value add deals this year. So that's a sizable amount to get some feedback. Let me put it like that. And some of the feedback I've got is, and compared to the new development built to rent products, I've seen more newer investors come into the value add side and largely for a couple of reasons, which I also liked. Firstly, you know that assets already up and running. Now that really drops the risks in a very big way because you're not
Substantially.
dealing with
Yeah.
absolutely.
Because
So no,
yeah, because if
yeah,
you deliver in a difficult interest rate environment on development, you want to be pretty in the money to make it make sense, which I'm sure you're vetting that with your, acumen. But having a delivered product already really de-risks the situation, and I'm sure the next reason you're getting into as to why you like it, but I'll let you share. I'll let you explain the reason why that might be.
exactly. And as I said, I've moved more into it because while in full transparency, new development seems a lot juicier when you look at the returns and you look at the risk profile as well. And in full transparency, there are certain type of investors who love that kind of product. But you need to be open to knowing that you're pretty much going on that ride with the developer, and there's certain risks which can come from permits and construction costs and just getting the whole thing up and running till you see it is risk. But granted, you're creating more value, hence the returns also probably look a bit more aggressive. But if you compare to value add, hey, that address is out there. You can see it exists. You can go to apartments.com. You can do a basic Google search. You can even drive down and see it yourself if you're in the neighborhood. So I love that fact. Second, also, if it's already cash flow generating, that gives me evidence that that product is working in the market. So that's another second feedback which I got, and this is my own money also invested, and I love that factor. And third is that, and probably most importantly, apart from the aspect that you can create a lot of value essentially by renovating or improving operations, it's just the basis which we've been able to buy these properties. And if I were to break everything aside and I had to explain it to myself or anybody, success really comes at what price you're buying. So I feel that this year has given tons of opportunity in terms of distressed real estate where general partners who are local to the markets have been able to purchase assets at least 20-25% discount. And I mean, compared to what purchase price the sellers may have purchased at the peak of the market in 21 22. So granted, there is that arbitrage because the difference in market cycles, but clearly from an investor perspective, that gives you that level of margin of safety, right? You're looking at properties where they have tax exemptions, for example. There has to be what I love about value add real estate is there's some level of story always behind a deal, which makes sense. And that is why it's almost surprising to my new development sponsor friends when I show them the kind of track record top operators like Lone Star Capital and others in the market have. Like, wow, 30% IRR, that's in a value add deal. How does that happen? Just because of the kind of there's just so much going on, so much opportunity there, and I feel from a new investor perspective, or someone even seasoned, to getting in with something which is already up and running, which is cash flowing, which is going to give you some tax benefits and a return much better than what you're going to find in the public markets, almost makes it a no-brainer. So I've been in love with the asset class. Put the other two on hold right now, but again, it may change with the market.
Yeah, no, and I love that explanation there, and thank you so much for the deep dive. Just going into the value add component of things, if you can almost give people stock market beta returns, call it, 8%, I would say stock market, market beta, if you will. That's why a lot of people have their preferred returns, typically speaking, around that threshold there, or the waterfall will come after that number there. But if you can give someone between a 4 to a 7% cash on cash return, either monthly or quarterly, that's awesome. Of course, we do it monthly after a full month of ownership. So theoretically, if we close a deal in the middle of October, right, we would have our first distribution coming likely then at December, the middle of the month there. But that's very exciting for a lot of people. It's very appealing that they get that. It's part of their supplemental income to their kind of portfolio pot, whether it be from retirement aspect or supplemental income to really leverage their dollars there, where it's not sitting stale and kind of getting destroyed by the inflation going on right now. Development is interesting. There's a lot to love about it, but some people kind of have a boomer bust feeling. And I think a lot more people have had experience of knowing someone who lost their hat and shirt on a development deal than a value add play. And I think the value add play is pretty simple right now. It's luxury versus necessity. I'm not comparing this to development, but why we love value add, multifamily real estate, for those who might know our thesis or might not know it, is you want to invest ideally in an area with workforce housing, which you cannot build that below replacement cost. So essentially we're buying our deals for 145 $165,000 per unit or so in nice areas in Houston. That's well below replacement costs. Replacement costs could be $200,000 in a lot of instances here per unit. So if you're buying on positive leverage below replacement cost, you're going to make a lot of money in a growth market. Don't trust me, trust Barely Sternlicht, who's one of the biggest stars in the industry for multifamily and investing. A savant in many respects, a pioneer and a tycoon. So that's his philosophy, and that's kind of a lot of how we look at it. Is the stability of the returns there, and also I think the other thing moving forward with the world getting automated, with AI obviously becoming a big thing, with technology being integrated in everyone's day to day. Ask yourself this: luxury or necessity? Do you need to technically work from an office? Well, I imagine you're working from home. I'm working from home right now as well. I'm the only remote employee at Lone Star. Of course, we've got beautiful office space here at the One World Trade Center, but luxury and necessity. Okay, housing and shelter is a necessity. Office, luxury. Retail, luxury. Amazon's also disrupting that as well. So that's how we kind of rationalize the multifamily space. And I think from a here to stay perspective, multifamily value add is, I would argue, the safest play in the real estate market. There are a lot more people that aren't living in penthouse in New York City. A lot more people live in Class B workforce housing throughout the country.
Absolutely, and I think that's a great point which you brought forward. And if you come to think of it, these residents are looking for, and if you're able to provide from a general partner perspective in-house property management, I just feel that there's such good incentive alignment, because you can ensure that these tenants are having great experiences, probably get renovated asset or renovated apartments if that's part of the plan. And by and large, the expectations are very realistic. And I think that's what I like about the workforce housing, is that expectation realistic. They're looking at it just to overall very good experience to live, and then you'll see renewal rates going up, and that would potentially, um, you know, help you in the valuations as well. So I feel I agree with you. If you look at everything, if you look at the whole play from what all value add has to offer, compared to the the builder rents and the new developments, etc. out there, the different real estate asset classes, I'll probably argue for the largest pool of investors, um, including the most sophisticated ones. Value add might be the right play.
Yeah, that's awesome. So let's get into some of the fundamentals that you look for when you say yes or no to a deal. How do you get through the hundreds of deals that you probably get, monthly at this point, where you say yes to no or something? I guess obviously you look at a sponsor level. I think we've gone through that, but from a metrics level, if the sponsor is seemingly checked out, are you looking for certain market metrics, certain markets? How do you decide what's a yes or a no?
Sure. So I do I'll put my broker hat on. So first, I would look definitely at the basis, like I mentioned to you. I'm always, I think that's the top criteria for me, is that I'm going to look at the basis to know what's happening in the comps out there. I'm going to look at the rental comps and want to get a sense of where's the value play over here. Okay, is there something? Is there need of that kind of product? Are there? What am I missing over here? Is there potential for the rentals to go up in value to be created? So I definitely look at comps, and that gives me a baseline understanding that okay, there is a margin of safety for me to play with. Second, it's also important for me to see the sensitivity analysis in terms of the cap rates. Now, cap rates can be a bit tricky because end of the day, there are a lot of different assumption factors that do come into it. But I try and see that has the general partner really thought this through in terms of a basic sensitivity analysis which they can share with me in the underwriting. In essence, I want to know is that where you're placed right now, what are you projecting that you're going to exit with, and what does the variation look like? In essence, what I like to look out for my investors is that, and it's a part of my conversation with them, is that how realistic is the part to the returns which you're looking at? Was that the best case scenario which I'm showing to you? Is that a conservative approach? Because end of the day, we are looking at symmetric returns where I want to tell the investor confidently, and while of course my incentives are aligned in terms of performance, my money would be involved. It's also my reputation at the same time, which is also at play over here. So how confidently and accurately I can explain it. So that's important for me. I also like to look at cash reserves in terms of whenever I speak to the GP that okay, how open are they to discussing that there could be issues in the deal? How open are they discussing that okay, we need this kind of a buffer? What's the minimum occupancy this deal requires below which we're going to have a capital call? Now, just to let this is how I educate my investors. I don't necessarily have an issue with a general partner who's had a capital call. But I do appreciate general partners who make it clear in their conversation with me that okay, there's a certain threshold which we need to reach, and this is a very likely path. It could be 60% occupancy or 70% occupancy, and there's evidence if the asset is already 90% occupied plus. So I know I have a well and good margin to play with, and that's been thought through. And in terms of interest rates, it's always good to also see. And again, there's a lot going on in terms of interest rates. I like to see how the GP is thinking this through. It could be a fixed rate which you've taken, that's also fine. It could be floating, but at the end of the day, what's the explanation and rationale behind the deal, and how whatever strategy you've chosen, what's the evidence that you can go by it? So to answer your question, these are the 4 or 5 criteria I like to look. I just like to see is that is every point really backed by some evidence already existing in the property? That's again what makes value add so exciting versus maybe new development where there are just too many assumption factors for one to look into. Here you actually have real evidence to go in. I would say a mix of all of this. Then location also matters to me. Not, and when I say location, doesn't broadly mean Houston or Dallas or Charlotte. Of course, it does, but really the sub-market where you are, how far it is from maybe the downtown or close time major employment offices, the airport, things of that nature. Because I've been a tenant myself, and I know that what do I look out for? I look out for ease of transportation. Look at Trader Joe's. I want Whole Foods close to me. Things of that nature where it makes my life comfortable, and I'm okay to pay a premium for that. So it's a mix of all of this. But I can also tell you what makes me reject deals, and I won't like to use the word reject because they are
Pass.
only pass. That would be
Yeah.
better
That's
because
that's very diplomatic of you.
and a lot of it is to do with I think the how I would put it across is that sure I may get 50 deals on my desk in a quarter. I won't deny that, but maybe 10 are only with the partners who I would really dig down and study. The other 40, sure, I would give a read, but maybe I might just look high level and just have enough pointers to not go deep, dig deeper, right? For example, I may directly see that I can see through the comps, I can see through the assumption factors, I can see through their extreme returns they're promising. So probably they may qualify in the reject category, but the pass category would always be with the partners who I'm working with because I know that good partners like Lone Star Capital, if you're looking for a deal, of course, what's important for me is firms with very good reputation. So, and I know it's an intangible factor probably to bring into the mix over here, but versus a random email coming to me with somebody who's, and I think, we all start up and that's absolutely fine, and you're gonna work your way up. Versus, let's say, a firm like Lone Star Capital, where an established track record, 10 on 10 reputation out there, where I feel firms like Lone Star Capital have probably a lot more to lose by doing a bad deal. So they may have their checks and balances and due diligence at a certain level, which already gives me confidence uh, before I dive in, right? So then it could be just reconfirming certain assumption factors. I think it's very intangible. Again, it's hard to point, but a lot of my investors understand this when I put it across to them. They value general partners who've been there. They value the quality material presented, the track record, because they see that, okay, these, or let's say the kind of acquisition, the acquisition number of acquisitions we've already done, that also matters a lot, because that shows that, okay, you know your market certainly well. There's a high probability that you've built that local expertise versus, the newer players probably coming across. So yeah, that's how I look at it.
Yeah, no, that all makes sense. And it's kind of funny on, your assumptions question. It's like, did it look like you were actually intentional with your numbers, or do you just kind of throw some paint against the wall, hope it would stick, and you manufacture the returns that you're looking for? So that's kind of what I heard you say there, which is super cool. It's like, hey, whatever you put in there, I'm not questioning it. I'm just questioning why you put it there. Help me explain your rationale. You should know more about the market than I should. So make me the expert. Show me that you're the expert. Show me that you can justify this going in cap rate, this exit cap rate. It's not a mystery that when you're in this business, in this space, by and large, the person who wins the deal paid the most. So why did you pay the most for this deal over the one down the street? Or was this just the only deal that even got offered to you and you took it because, you have got no background as a sponsor, you've got no history. So yeah, I guess this broker can take a shot with you paying the most in hopes that you actually come through and raise the money for the opportunity. The other thing I thought about that you said too is, hey, where could this deal go wrong? I think it's a really good question to ask a sponsor, and a truly fair one, where it's like, hey, a thing or two, like, why is this deal, where could there be a blinder? Okay, well, our deal in Dallas, hey, we have to renovate a lot of units. One that we bought this year, Grand Riviera, we've got to renovate a lot of units. We do know that there's organic rent bump, but we spend X and don't get it. Well, that will obviously manufacture or deteriorate the opportunity there. Maybe the exit cap rate, people can't justify on the back end. So you play with that sensitivity there, but then at least you could see the sensitivities going through that opportunity. So to your point there, tell me what you think are the pros, but also, there's a con or two. There's no perfect deal. There's no, oh, well, if you have this, there's that. We all know that there's some blinders, that there's some weak spots to any opportunity, but just explain to me calmly how you can avoid those miscomings, right? Is that kind of what you're getting to there with some of the questions that you ask a lot of sponsors?
Absolutely. And I want to understand that they've done their homework. And my question to them is always that, hey, like me for a fund manager, or for my investors, they have a lot of deals to choose from, right? And then they may select one. It's a competitive space out there. What made you choose this deal in your right wisdom out of your other deals out there? What got you excited for you to put your hard earned money, your time and energy, your reputation to carry this forward versus what's out there? And then, that's important for me. Then I want to see is that, okay, their proven ability to execute on the deal. Okay, that those factors come in together with me. But I always, for the back of the mind, I'm always seeing is that, where I where is it possible that there should be no chance that the deal should lose money, because we all can do less with maybe 5% return here and there, but nobody wants to lose their capital. So
Yeah, how are you
I'm all,
de-risking the opportunity, right?
absolutely. So that's always in the back of mind. I'm asking the GPs that, what are you doing to completely de-risk it? Like, what have you thought through? And that's when the other aspects start coming together. Incentive line with the kind of fee structures going through, or how they've thought through their assumptions, and that starts making sense to me. That, okay, and like we discussed earlier in this conversation, what gives me a lot of confidence is a 3 to 5 year hold, because I know for a fact that if I'm giving, end of the day, you give any asset time, the natural forces of the market have to take place, and things is cyclical, things would appreciate, there is demand, real estate is location driven. If you really break it down, it's not that complicated, right? We are still protected from AI and management mishaps and CEOs changing to really impacting our valuations versus the stock market. So we know that by and large is going to be a demand supply based business. If you're in a good location, there's a lot of migration taking place, there's a lot of demand, limited supply, your valuation is going to go up. It's really about the time of getting the right pricing in the next 3 to 5 years. So that's how I like to look at it and try and keep it simple like that. And I think most of my investors, when I break it down for it like that to them, they also understand that. They're like, okay, end of the day, that's the advantage of real estate is that it really protects us from like all those other things which we can't control.
Yeah, without a doubt. Well, you've been such a great guest. Final question for you here. What are you most looking forward to with the cycle obviously changing? We just had a rate cut not too long ago, although treasuries have ran up to basically where they were before pre-cut, which is a
Sure.
topic for another day. But what gets you most excited with kind of the state of the market, for it being in the position for the better or worse?
Sure. I just feel that from an investor perspective, there's going to be a lot of opportunity in the next 6 to maybe 10 months. If I'm generous, 6 to 12 months. The reason I say this is that 2023-24, depending on which market you look at, one of these major markets in the Sunshine Sunbelt region, quarter to quarter, I've seen multifamily construction starts to be down from 20% to up to 50%. So, in essence, due to the high interest rates, strict lending standards, and difficulty of developers to make numbers pencil out, we are just not going to have enough supply out there late 25, 26, because all the supply which is supposed to come to the market is somewhere down by 20 to maybe at some markets up to 50%. And I feel that's going to really open up an opportunity because any new development also for an apartment complex to come should, it's not going to come up overnight. It's going to take at least a year, if not a year and a half, for everything to be up and running. So I see that all these acquisitions we're able to do in the next 6 to 12 months at great paces, good markets where there are clear migration trends. We would potentially be in the market in 26, 27. Of course, with interest rates coming down, anticipated home prices to go up, pent up demand, more people will lead towards renting. And at that time, we will potentially be in an undersupply market. So I feel that in the next 3 years or so, without sounding very cliche, based on all my studies, this could probably be the best time to buy value add multifamily. Just because if the location is already established, there's already very good demand, proven with high occupancy, it's all about getting those rent bumps just because of simple demand supply metrics, nothing else. So I know it's harder right now for a lot of people to see through that, but those investors who have been able to work through and are seeing through that really see this as truly a fantastic opportunity to get in. So let's see how 26, 27 goes. I'm excited to see the next 6 months and the opportunities operators like you bring to us, and excited from investors as well.
Yeah, excellent. Well, where can people find you if they want to get in touch with you, network with you, maybe invest in one of the offerings you have coming up? How can people reach out?
Great. So you could go to my website, sondhicapitalgroup.com. I have some good investor resources like Investor 101 course and for build to rent as well. But I'm most active on LinkedIn. So you can search me Nishant Sondhi, and I do tend to post good 5 to 6 times a week my views on the market, updates on what's happening on my projects, and be happy to connect with you on LinkedIn.
Awesome. Well, thank you so much for being on the show today. We appreciate it. For the listeners, we appreciate you the most, and we'll see you next week. Peace.
Thank you, Greg.